So we're going to continue what we were working on last class. We'll finish up the class notes on liquidity. Then, I told you last class I was a little struggling. When do I go to Walmart? And I'm going to go to Walmart immediately just in case I don't get as far as I'd like to, and then you can start your company. So we'll do the class notes, then I'll do liquidity for Walmart. Hopefully we can get through solvency today. At least get through solvency, maybe start turnover a little bit, but we'll see. So we'll start with the class notes with liquidity. So last class we talked about this working capital requirement. It's a little bit tough. Today we'll see why it's so tough, especially for accounting majors, because it is very different than what we're taught in accounting. But let's look at working capital. Remember, working capital are those assets, receivables, inventories, prepaids, and those liabilities, accounts payable, trade payables, accrued expenses. And I'm going to keep adding unearned revenue because for a few of you firms, that's a really big deal. So I'll keep adding those. These may end up in the notes I give you for the class, but I'm adding them here to the notes I'm using. So what influences these? Remember, we want to try to keep these three as small as possible. We'd rather have our customers pay us than for them to owe us. We'd rather build the inventories the last possible second or buy the inventories the last possible second versus having them sit in our warehouse. We'd rather not have to pay things in advance, although we don't have much flexibility there. These things, we want to maximize them as much as we can without causing problems for our vendors and our customers. So if we can pay our vendors later, we pay them later. If we can pay our employees later, we pay them later, although we usually don't have much flexibility there because employees get real upset. We pay them a week or two later. Unearned revenue, if we can get our customers to pay us early, like I mentioned with airlines, pay for the airline ticket or pay for the hotel room before you use it, that's a wonderful thing. We love that. That's like them loaning us money for free. So how do you influence these? Well, first, you manage your receivables and your inventories and your payable processes as much as possible. It is closely, I mentioned this earlier, it's closely tied to activity ratios. We'll bring those in. If you can improve your receivables turnover or your inventory turnover, that is, you collect from your customers faster, you turn over your inventory faster. That's a way to really improve this ratio. Just look at whether net working capital is a source or a use. You'd rather it be a source, or if it's a use, you want it becoming a declining use. You want it to be smaller and smaller relative to the rest of the business. So you may see some firms talking about a new inventory management system. And so this is something I think is really, really important. Supply chain management is something you really need to get into your normal conversation about business. Supply chain management. And look that up. If you're interviewing with a firm, I would go out to Google or to the internet and do a search on supply. Let's say you're interviewing with, I don't know, Walmart or HEB. HEB might be a little tough because they may not have much out there on the internet, but do a supply chain management for Kroger's. It's an extremely important part of their business. How does HEB source the produce that they sell in their stores? How do they source the stuff they put on their shelves? What is that process? You want that process as efficient as possible. I'm sure HEB does a great job of that. Kroger's does a great job of that. That's a big part of their business. Something else you might have in your bag of tricks when you're interviewing is the value chain management. Value chain management goes beyond just supply chain. It includes the supply chain, but it includes human resources. So if you're interviewing with a firm, you want to know, how does management manage these incredibly important processes like receivables and inventories? Supply chain management, value chain management. If you're interviewing with a large publicly traded firm like a Walmart or a Kroger's, Value chain management goes well beyond. You could do it for Delta Airlines, Southwest Airlines. You can go to the internet and just say value chain management for Kroger's, and all kinds of material will come up. And if you did that before you interviewed with a firm, they would be very, very impressed, because this is a huge part of their process. How do you manage the operating cycle? So just some terms, and you might even just look up these terms. The most important writer for value chain management is Michael Porter. You may have heard of him before. We'll talk about him a little bit in this class. Extremely important. I've read his books. They're a little bit tough to get through because he goes into so much detail. But if you really want to understand business, sometimes you have to go through that tedious part of understanding the business. And Michael Porter goes through that in quite a bit of detail. He's a very influential writer. You may have heard of his Porter 5 Forces, and we'll talk about some of those maybe in this class a little bit, not much. You'll get that more in your management classes. But these are the kind of things that he writes about. Supply chain management is a little bit different than value chain management, but certainly is part of it. So if you're a management major, this is going to be major to what you do. The supply chain management, the value chain management, is how does the management manage all these processes that the business do, whether it's investment technology, information technology, supply chain management, human resources, production, all those kind of things. How do you manage all of that? So that's what we're after here. Firms that do that kind of thing well, they will see a huge improvement in their working capital requirements. They'll see it move from being a large use of cash into being a source of cash. There are definitely industry influences on this that you want to know about. So that's one reason the way we're setting up your first paper is to do these industry influences by looking at what's typical for the industry. I can't give you the rules of thumb for the industry, but you can look at 15, 20, 30 companies in industry and see where they are. What is the normal ratios for them? And then you want to see if your firm's getting better or getting worse. And then firms that are growing tend to have problems with these ratios. Fast-growing firms, like an Amazon, like a Zoom, they will tend to have problems in these areas. They'll tend to see their receivables and the inventories. I don't know if Zoom has any inventories, but definitely receivables. They'll tend to see these grow much faster than the rest of the firm, and tends to create huge issues for liquidity. So let's talk about how the accountant. So here, I told you I'd love to do a debate with an accounting professor. If y'all ever want to set that up, just let me know. Might be embarrassing, but I'm fine. I don't have a PhD, but I have no trouble going toe-to-toe with a PhD in accounting. Not that one wins and one loses, but more to get students engaged in these discussions, because this is incredibly important to your career, that you understand these things. This is what makes businesses work. You should be very intimately involved in these type of issues. They're extremely important. So how the accountants look at it, they look at not at working capital requirement. They look at net working capital. Net working capital includes cash and includes short-term debt. Remember, in our net working capital requirement, we did not include cash. We did not include debt. Those are not operating assets. So it's a little bit different concept. But they look at working capital, which is current assets minus current liabilities. And then they have something called the current ratio. I hate the current ratio. I do not use the current ratio. It just doesn't work for me, but accountants use it a lot. And in fact, most of my students, the current ratio is the first ratio they give me on any type of analysis. And I'm like, we don't use that in finance. But what is the current ratio? It's current assets over current liabilities. And what your accounting classes will tell you is we want this number to be higher, not lower. And the higher it is, the more liquid the firm is. And especially we want this ratio above 1. Finance says no, we don't look at it like that at all. Why is that? Well, because a big part of a current assets is receivable and inventories. And essentially the accountants are telling us firms that have a whole lot of receivables and inventories are very liquid firms. Finance says the exact opposite. We don't want receivables in inventory. Those are extremely illiquid. That's cash we don't have because we spent all this money on inventory and now it's just sitting there waiting to be sold. That's a cash drain. Our receivables, we sold all this stuff to our customers, but they haven't paid us yet. That's an illiquid thing that harms us. Now they try to address some of that with the asset test and the quick ratio. It's do the current ratio, but let's exclude inventories. But that doesn't help us any because receivables are not wonderful things. We'd rather have the cash than have a receivable. Now, obviously, we like selling stuff, and when we sell stuff, we get receivables. So receivables are good in that sense. But I'm talking about the choice between having the customer pay us versus having them owe us money. I'd much rather them have paid us than they owe us money. So you really cannot access liquidity just looking at the balance sheet. Those ratios really and truly do not tell you what's going on with liquidity. You need to look at a full set of financials, and especially the cash flow statement. What the current ratio ignores is the fact that this firm has a lot of cash from operations. The current ratio somewhat implies that the only thing you have to pay your liabilities are your current assets. The only way you can pay your accounts payable is by collecting on receivables. But that's not true. A firm like Walmart has almost no receivables. They have a bunch of cash coming in the door that they can pay their payables, and what they're paying their payables with never hits the balance sheet. And talking about Walmart, let's look at Walmart. So let's consider Walmart as our example. And let me just show you the numbers for Walmart. So here's Walmart. I also threw in Dell because Dell is another example. These are two extremely liquid firms. They manage their liquidity better than almost any other firm out there. So when you're talking about liquidity, finance will say these are two impressive firms, very liquid firms. So here's their current assets. Their current assets are cash, receivables, inventory. You can see for Walmart, inventories is a huge issue. So they have $62 billion in current assets. $44 billion of that is inventory. Here's their liabilities. They have accounts payable, short-term debt, and other. Look at their current ratio. Their current assets are much less than their current liabilities. Their current ratio is only 0.79. Dell, even worse. Dell's current ratio is 0.7. So accounting will say, wow, these are two very illiquid firms. And finance will say these are two very liquid firms. So why is that? Well, let's look at the working capital requirement. Their working capital assets are $52 billion. You notice with Walmart, we leave out cash and cash equivalents. That's not a working capital requirement. It's not a working capital asset. It's a current asset, but it's not a working capital asset. Cash is not a working. So anytime you see working capital, we're talking about those short-term current assets that are tied to operations. Cash is not tied to operations. Remember, it's the result of operations. It's what comes out of operations. So $52 billion. Their working capital liabilities are $63 billion. So everything excluding the debt. Debt is a current liability, but it is not a working capital liability. So their working capital requirement is a negative number. Remember, for us, a negative number is good. That means that their operating cycle is a source of cash. And why is that? Well, for Walmart, they have inventories that they get from their accounts payable, from their vendors, but they sell this inventory before they pay their vendors. That's the reason their current ratio is below 1. It's because they're managing this so well. This is wonderful. They have inventory, they sell the inventory, they collect from their customers before they pay their vendors. So they're never out of cash. Their operating cycle is constantly producing cash. That is a good thing from a finance standpoint. Dell even more so. Look how small Dell's inventories are. Dell sells computers. But what Dell does, which is really interesting, is they don't make the computer until their customer orders it. So you go online to Dell, you tell them what computer you want, you put the order in, that's when Dell creates your computer. So they don't have a lot of inventory sitting there. And just like Walmart, they pay their vendors after they collect from you and make your computer for you. So it is an incredibly liquid company. So this is the argument I would make on why I think the current ratio is a bad ratio. Now, some accountants will say, well, doesn't the current ratio still give you some information? Wouldn't you be concerned if it got really out of sync, or if the trend was bad? And I would say there are times where the current ratio is telling you something, but I cannot tell you a time where the current ratio is telling you something where you wouldn't get that information with other, better, more accurate ratios. So the working capital requirement and looking at short-term debt, that's the two things I would do that would tell me everything I need to know that's in the current ratio, but not telling me. The current ratio gives you so much bad information that a few times it's telling you good things. I'd much rather have the net working capital requirement ratio and look at the firm's short-term debt, make sure it's not getting out of line. That would tell me much more accurate information, be consistent over time, and tell me everything. The few times the current ratio is telling me good stuff, those two ratios would capture that well enough. So that's my argument. I'm sticking with it, but if any of y'all want to set up that debate, let me know. I'll go for it. So what do you look at for liquidity? All right, so let's look through this. The first thing you do is look at trends in cash from operations. We are going to do that. We're going to keep it really simple. I'm just going to say, what is the growth? What is the growth in your cash from operations? We're going to save this part here to a little bit later. We're going to put this under solvency, so don't worry about this. But just looking at how does cash from operations grow versus how do earnings grow. We'll call that quality of earnings, but again, I'm moving quality of earnings down to the solvency part. So you won't do that under liquidity. Trends in working capital, you'll definitely do that in your paper. I actually have a graph that I give you that shows you how to do that, and I'm going to show you how you can do additional analysis to figure out why the trend is there. Is it because receivables are growing too fast, inventories are growing too fast, payables are growing? So we'll actually look at that and see what's going on. We'll try to give a why to that analysis, to make it a stronger analysis. Use and structure of debt. We are not going to cover that. You're certainly welcome to do that if you like. You will have that information, but we're not going to cover that in the paper. We are going to talk about debt under solvency, but what we talk about with liquidity is if a firm has a good debt line and a liquidity crisis comes up, they have the ability to go out and borrow money. That's good. We don't want to make sure they're not overusing short-term debt. Well, again, that's more under the solvency side. So these two we will not cover in paper, in your paper, in your project. Sources of liquidity. So how large is their debt program? How much have they already used? How many debt sources do they have? Do they have backup lines of credit? Do they have alternative sources of liquidity? So let me just talk through it. We're not going to cover this in your paper, but it's still extremely important. So let's just quickly talk to them, and I'll give you my USAA example of this. So at USAA, I think they had, at the time I was there, they had like a $3 billion debt program. So USAA could go out and borrow $3 billion. They had that broken between short-term debt or commercial paper and medium-term debt. So some short-term, some medium-term. Most of their debt was short-term because it funded their banking operations. So you could look at how much debt was, how large is USA's debt program. Every company has a debt program. You don't just go out and borrow $10 billion. You have to set up the program. You have to do a lot of contracts, especially with your backup lines of credit. So, there's a lot you have to have in place. So you don't just say, hey, we're going to go borrow $5 billion. You have to have your debt program set up. So one part of liquidity is how large is your debt program versus how much have you already used up. If you have a $3 billion debt program and you borrow $2.9 billion, you don't have much liquidity there. You only have another $100 million that you can borrow. We also looked at the variety of debt sources. We learned this at USAA after 9/11. At 9/11, USAA thought, well, we have banks all over the country. We have some banks in Philadelphia, in Chicago, in Boston, in New York. So we're pretty diversified. When 9/11 hit, it shut down banks throughout the United States, not just those banks in New York City. In fact, there were some banks in New York City that were up and running faster than banks in Chicago. So 9/11 was a really huge test of these banks' backup capacity, their ability to get back and operating after a major crisis like that. That was obviously a horrible time in U.S. history. And many banks just had to shut down for many more days than they thought they would have because they did not really test the system. And so what USA learned was to have some overseas banks, some banks in Europe, so that if something happened in the United States, especially in New York City, they'd have the ability to go overseas. And then you have backup lines. Anytime you have a debt program, your lenders will require you to have a backup lines of credit. And the rating agencies too, when they're rating you. They want to make sure that if for some reason the debt markets freeze up like they did in 2008, at the end of 2008, it was just impossible to go out and borrow money if you're a corporation. So what banks do is they provide backup lines of credit. And what they say is, hey, if you cannot borrow in the debt markets, we will loan you money. Now, there's committed lines and uncommitted lines. A committed line is we will pay the bank money so that when that time happens, they'll have to loan to us. So we might pay them 0.001 or 0.1% a year just for the right to come borrow from them. And that's a committed line of credit. That's what rating agencies want. USA had about 50% of USA's debt program was backed by committed lines of credit with banks. You can have uncommitted lines of credit. There you don't have to pay for it. The bank says we feel like it, we'll loan you money, but at least we have all the paperwork and everything set up, and that's important. And then you have alternative sources of liquidity. At USAA, we could sell our assets. We could do what's called securities lending. Very important. I don't talk about securities lending in this class, but in some other classes I do. It's very important. So if you have a lot of assets, a lot of securities like stocks and bonds, rather than selling them, you can essentially borrow against them, and there's a whole process set up. But again, you have to get it set up in advance. You don't want to wait until the crisis happens and then say, hey, we better have a debt program, we better have securities lending. No, you have to get those set up with the contracts, with your custodial banks. All of that has to be set up in advance. And so what USAA did, which I thought was very healthy, we had something called the Corporate Asset Liability Committee. Corporate Asset Liability Committee, also known as CALM. It was our Risk Management Committee, which I thought is really cool that our Risk Management Committee was called the CALM Committee. So it's like, don't worry, we got it under control. Our new CEO came in, Bob Davis. He heard about this committee and he immediately said, I will be attending all of your meetings, and he did. It went from being a committee that 10 to 15 people showed up to a committee where 50 people showed up because everybody wanted to hear what the CEO had to say. And he was very good when it came to risk. He wanted to know the details. And every single quarter that we had a meeting, we went through in detail all of our sources of liquidity. And we tested them. So if we had backup lines of credit, we would actually use them just to make sure they were there. If we had a securities lending program, we would actually test it. We'd actually borrow against our securities even if we didn't need to. We'd go out and borrow $300 million for one day. It would cost us a few $1,000s in interest, but that was just to test it and make sure it was actually working. So a very strong program. This is what you want the companies that you work for, that they do, that they go through all these details to make sure when a 2008 happens, when a COVID-19 happens, they can weather that storm because they have all these backup facilities. The other thing you think about with liquidity is any potential shocks you might have. So you might have some debt covenants that require you to repay your debt as certain things happen. That's terrible. You don't want, because just think about it. There's some firms that borrow money and they have a debt covenant that says if we get downgraded to below investment grade, we have to pay off all our debt. Well, that's terrible. At a time where the firm's being downgraded, so something bad's happening to the firm, and now their debt contracts require them to come up with all this money to prepay their debt. That's terrible. Some firms, like the tobacco companies, had huge litigation problems. Some firms, they may have one customer that represents a big part of their revenue. So if you're doing Lockheed, one of your biggest customers is the U.S. government, and you have a new president coming in. How is that going to impact you? We saw with COVID-19 with the airlines and the cruise lines that their revenue suddenly dropped 80%. How do you survive something like that? How do you pay your bills? How do you pay your employees? How do you pay your vendors? How do you take care of your planes? You got all these pilots, airline pilots. You don't want to just lay them all off and then they're going to go work somewhere else and you can't get them back when the time comes. How are you going to handle all of this? So that's one. We're not going to cover that in your first paper, but these are all important. Just because we don't put it in your paper doesn't mean they're not important. You shouldn't learn them. The last one is how free cash flow is deployed. We will definitely have that in your paper, and I'll show you how we'll do that. We'll look at how the firm's doing capital expenditures. Are they buying their stock back? Are they paying dividends? Are they paying down debt, or are they borrowing? Are they buying back stock, or are they issuing stock? So we'll have that in the paper, and you'll see that, all right? So those are the three biggest things we're going to cover in your project. So what we want to do now is move over to Walmart, and I'm going to walk through a few things with Walmart first just to give you an understanding of the project. So the first thing is your Excel spreadsheet. So you might want to hit pause on this video if you do not have your Excel spreadsheet open. If you only have one computer screen, I'd recommend the main thing you look at is your company. You might have your company and the Walmart. If I say Walgreens by accident, I'm talking Walmart. So ignore. Sometimes I'll say Walgreens when I mean Walmart. So just ignore me if I do that. So you should have the Walmart open and your company. But what I want you to do is focus on your company. And as you're going, press pause on the video and then start collecting your questions that you have. Things for your company that is you just don't understand. You're not really seeing what they're doing. And then when we have our one-on-one live or small group live sessions, you'll have your questions ready. And if that doesn't work, then you can definitely call me. In fact, I'd recommend you call me before your live session. Get your questions answered in advance. Get ahead of the curve. Be ready to go. You can email me your questions. You can call me. Call me is probably better because it's hard for me to answer a lot of emails if they all come at once. But I'll do my best depending on the volume. But call me is the best setup sometime. So have your company open. So while you're seeing me walk through Walmart, you can look at your company and compare and try to see the difference. This first part of the spreadsheet gives you instructions on how to use this spreadsheet, but I've already done all this for you. However, I do recommend, especially accounting and finance majors, that you actually go through and create this spreadsheet. Do exactly this. Go into the Bloomberg lab and do this. You can't do this from home. You have to be on campus to do this. But go into Bloomberg lab and actually do this for yourself. Create this for another company. The reason I say that is, and even if you're not an accounting or finance major, when you get to your capstone class, you might find that this spreadsheet is quite valuable to you. Or you might find that you're in an intern where they're going to give you a project that's very much like this, and you might have access to Bloomberg in that intern. You could take this spreadsheet and you could use, I've had students do this in interns. Do this spreadsheet in an intern project and their team wins because they had all this data. So, remember the spreadsheet, don't lose it. Even if you're an IT major, you might find a value for this spreadsheet later in your career at UTSA or even in your career. The next part of the spreadsheet just has a list of a bunch of companies. This is how I came up with the competitors for your company. This is the Russell 3000. It's not quite 3,000 companies. It's about 2,950 companies. Once a year, it's 3,000 companies, but the rest of the year, companies merge or go out of business, so it dwindles down below 3,000. It's a great resource. In fact, I encourage students, if you're interviewing with jobs, it's volume. You might go through every industry here and just look at the largest 2 or 3 companies. So the largest aerospace are Boeing, Lockheed, and Raytheon. You might just try to do 5 or 10 companies a week and just industry by industry, and starting sometime in probably July, August, just once a week, apply 5 to 10 companies. If you can do more than that, do more than that, and just keep applying for internships, for full-time jobs, depending on where you are. So probably for you, probably internships after your junior year. It is just volume. You're honor students, so you're going to be highly sought after students, but they can't seek after you if they don't know you're there. So just apply online, get your resume out there. And so this Russell 3000 is not a bad source to do that. It gives you a great list of companies. I don't know if I would do any of them under advertising, but it gives you a great list of companies that you can certainly interview with. And I've got it by industry, by size. So if you look over here, the largest companies down to the smallest. And it goes industry by industry by industry all the way down. There's a lot of them. If that's too much, then you could resort this and resort it by column F. Column F is sectors. So if you sort it by sector, it's a much higher, there's only 11 sectors or 12 sectors. So you wouldn't get as many, but if you did 10 out of each sector, that's 120 companies. So it'd be a lot of companies to apply to. The next one is how I bring in the data from Bloomberg. So you don't have to worry about this. I've already done this for you. But if you're doing this yourself and building it, you have to look at the instructions there. Then it brings in the data. You look and you notice it's all zeros. The reason it's all zeros is I'm using the if-error function. And the if-error function says if I get an error, error gives me a 0. Well, you'll notice this formula right here, BDH. That's a Bloomberg data history function that only works when you're on a machine that is tied to Bloomberg. You'll be able to tell if you are because you'll have a Bloomberg add-in at the top of Excel. Because my machine at home, I'm coming from home here, I don't have Bloomberg at home. I used to when I worked at UTSA, but I don't now. Because my machine's not tied to Bloomberg, the data can't come in. I'm getting errors. Because I'm getting errors, it's just going to give me all zeros. So now you're thinking, how in the world can I use this spreadsheet if I got all zeros? Well, the next sheet takes all the data that I got and pasted it as values. And so you have values here. So if you had run the Bloomberg machine, you would have gotten all of this data in the formula. So I just took this entire page here, copied it, and pasted it here as values. So I have all the data. Look at this spreadsheet here. I have Walmart at the top. That's its ticker, WMT. And it comes down the page. And a line 51, so you can see everything I have for Walmart. This line is not actually in yours, so I'll take that out. Everything I have for Walmart. And then the line 51 is Costco. So I'm picking Costco as the main competitor. That comes down quite a ways. So you can see all the data I brought in for Costco. Again, it's Walmart. The reason I have Walmart in there twice is you'll notice at the top of the spreadsheet, I go from 2020 or 2019 for some of your companies, and I go earlier in time. When you come down to line 101, I wanted to have Walmart, but I wanted to have it from earliest to latest. That just made the spreadsheet easily work. We might look at this some, but you don't need it for your projects. So really all you need is through line 99 and then this bottom part. The bottom part, what I'm doing is I'm bringing in the competitors. You can see for Walmart, I brought in 48 competitors. And that's what all this stuff here is here on the right. It's all the competitors. So like here's asset turnover. We'll talk about asset turnover here in a little bit. But here's the asset turnover for all of these companies. I don't know what this up here is. I think that was supposed to be years and it just didn't do it correctly. But anyway. It's a formatting, so don't worry about it. The spreadsheet's fine. There's some formatting issues that don't affect what you're looking at. So there's everything we have. I I bring in some credit ratings on Walmart and Costco, and I bring in the relative value analysis. We'll do that after we do the template. So that's just all your data. You don't have to worry about this, but I'm just letting you know what you have. It will be a little bit important in some areas because there are some times, like with inventory, you might want to actually come in here and look at the actual numbers. And so you'll have to go look for them. I'll show you how you can find them because it's really not that difficult. So there's Walmart. Now the next two pages, they're called print page 1 and print page 2. Those are the ones you're going to be doing. Print page 1 is all set up for your company, and it has data. Yours might only go through 2019. I'm thinking about updating some of yours for 2020. However, given COVID-19, I really don't want to do that for some companies like a Delta who saw the revenue drop 80%. It really messes up the data, and I don't want you to have to deal with really, really bad data. But I'll find some companies that work. This really isn't 2020 for Walmart. Walmart's 2020 actually ends February 2020. So this is really more 2019, but just the way they define it as 2020. But here's all their data. Here's the CAGR. I talked about the CAGR earlier. The CAGR is 2020 divided by 2011 raised to the 1/9. Why the 1/9 power? Because 2011 through 2020 is 10 years, but to do a CAGR, you have to have a starting year. And so if you have 10 years of data, your CAGR has to be 1 divided by 9. And that gives you the annual growth. So their revenues have grown a really paltry, really weak 2.44%. If you think inflation's been about 1.7% the last 10 years, their growth of revenues has just barely kept up with inflation. And that's not good. We'll talk about it a little later because they've added a lot of stores in that time. So you would have thought their revenue would have grown a lot more than that. But those are the numbers. So we'll be using these numbers. Everything you need is here. And at the bottom, I even give you some extra data that you can use. So, you've got a lot of stuff here to use. The next page, print page 2, is all your graphs. So every graph you have built, well, I'll talk about which ones you use, won't use. You're going to take these graphs and you're going to copy them into your paper. I actually recommend, you'll see what I do with Walmart. You'll notice that I created a whole new sheet called Graphs Used for Walmart. So what I actually recommend that you do, look at this chart 1. Here's chart 1. Look how there's way too much white space here. So I took this chart 1 and I copied it and I put it on this Graphs Used for Walmart and I pasted it right here, and then I changed the axis so that it wouldn't be so much white space, and then I changed the title, and we'll talk about chart titles as we get into this. I changed the chart title so it was more descriptive. The original chart title didn't tell me much. This chart title shows me that their growth and cash from operations is pretty weak. And so that's what you'd want to do is bring in your charts. You may have to renumber them. You want to change the title, fix the axis. And so I recommend you do that. That way, if something goes wrong with this chart, you can go back here and you have the original chart. You can just delete that one and start all over. So I strongly recommend that. What you need to do is not use my graph for Walmart, but just click this plus sign right here, create a new sheet, and you call it graphs for whatever company you're doing. All right, and you can put them there. So this is the spreadsheet we're using. There are a few other charts that are interesting. This page, I like to do all my data for graph building in one place. You might need to go into this graph occasionally. We'll talk about that when we do our one-on-one or do our small group online sessions. Sometimes you'll have a number that is so radical. Let me just show you, like right here. Well, I didn't make that radical enough, so let me make it even more radical. So something like this, when you see something like that, you're like, okay, that's just too much. And so you go to that and you essentially just delete that cell and just take it out. So we'll talk about that you might need to do that. Walmart doesn't have much of that, and I'm picking companies that don't have much of that, so we won't have that problem too much. You'll notice sometimes I do a chart where you're just comparing to the competitor, and you'll notice on print page 2, let's look at debt to EBITDA, and we'll talk about that ratio in a little bit. I have it both with Walmart versus Costco, but I also have it versus the industry. So right now I'm going to tell you, if you have an industry chart, I prefer you use the industry chart. And we'll talk about how you might edit some of these charts. Again, that's the reason why you want to copy it and put it on the other page, because you'll notice, see if I can find an example of one. I can't show you one with Walmart because Walmart doesn't have too many problem charts. But you'll notice on some charts, well, like on this one, I took out the 10 percentile because it just didn't make any sense. So I took out the 10 percentile. Here I left everything in because I thought it told me what I needed to know. So you might sometimes actually take out the 10 percentile and the 90th percentile because you just want to compare your company to the median of the industry. So there's many different ways you can do this. So let's look at Walmart. It looks like I'm not going to make it much further than just liquidity today. We'll see how far we get. That's fine. Liquidity is the hardest, and we're setting all this up. So now what we want to do is look at what you're going to build here. So let's go to the Word document. So you have this Word document for Walmart. You are allowed to use this as your starting point. You don't have to type this from scratch. So I've already built your starting rough draft. You just have to go in here and make sure you change Walmart to your company name and then bring in your graphs for your company all the way throughout, and you'll use the same graphs. I want you to follow this template precisely. If you're a finance or accounting major, you want to do more, I'll give you some ideas of extra charts you can build, and I'll definitely give you extra credit if you put extra analysis in. A good example is I don't have an inventory turnover chart in here, but it's an easy chart to create. If inventories is a big deal for a firm like Walmart, it is, and you want to put an inventory chart into your paper, then yeah, you can do it. You have everything you need to build it. So I'll give you those options to do those kind of things. All right, so let's look at what we have. So you have an introduction. You put your name up here. You put your company up there. Make sure before you turn in your paper at the end, you do a search on the word Walmart and a search on the word Costco to make sure you have those out. If you're not doing a retail company, you might do a search on the word retail. So Walmart, Costco, retail. So if you're doing Lockheed, you probably don't want to talk about the retail industry in your papers. So there's some stuff in here that's specific to Walmart that you do not want in your paper. Have an introduction. I always like to have an abstract that says, what am I doing in this paper? You notice I like to use 2 columns with narrow columns. I strongly recommend you get in the habit of doing that. 1 column papers just look very unprofessional. I think this looks a lot more professional. It looks a lot like what you would see in a professional journal. So columns with full justify, narrow columns, full justify, even like using a little letter to get it started off, just to make it look as professional as possible. So let me walk you through it. I'm going to walk you through Walmart. So for liquidity, there's 3 things I talked about. The first one is the trends in cash from operations. So when we're talking about liquidity, so we're going to talk about 3 things on the liquidity. The first one is trends in cash from operations. We can see their cash from operations grew from 2011 to 2020, hardly grew at all. You have to change these adjectives. Growing, I use very subdued pace. I had a student keep those terms, and their cash from operations are growing like 23%. So this has been growing at a very subdued pace at 24%. I will count off for that. That doesn't make sense. So try to find a good, go out and use the thesaurus and find a good term. I like to use the word subdued, anemic, strong. So use a word that really tells you what's going on here. And then I changed the title of my graph. I said CFO growth volatile with anemic long-term growth. Here I used the word anemic. Some fine words. So what I want with the chart title. The chart title should tell you first what the graph has. So CFO, So that we know this is cash from operations. But tell me, why did you put this graph into the paper? What is the graph telling you? And what I want my boss to see is how weak the CFO growth is for Walmart and also how volatile it is. All right, so what's going on here? I think this is Amazon. And what's going on with Amazon more than anything else? This 2020 is a little deceiving because we know Walmart did really, really well in 2020 with COVID-19. But again, this 2020 stops February. I would probably have added that if I were doing this as a paper. I would have put a note that Walmart's 2020 ended February 2020 before the lockdowns and COVID-19. That would have been very, very important to add to this paper. Most of your companies will be through 2019, so you won't have that issue. So the first thing is very, very easy. Man, easy points. Just talk about the growth in a CFO and tell me whether it's a good growth or a bad growth. The second part's the hard part. So here's where you're going to be challenged. So you'll have to flip back and forth between the Excel document and the Word document. What you're going to do at the very end, if you go to the very end of this Word document, you'll notice that I copied and pasted the Excel table in here, and you'll want to do that as well. You'll have to clean it up some, and I'll talk about when we get into that how to clean it up. But we're talking about the net working capital requirements. So there it is right there for Walmart. Their working capital assets are $52 billion. Their working capital liabilities are $69 billion. So their working capital requirement is a negative number, negative $17 billion. So their working capital requirement is a source. Remember, if this is a negative number, then the working capital requirement is a source of cash. Now, some students, listen real carefully, some students get confused. This first column is the growth rate. The growth rate is a positive 6.7%. But looking at the net working capital requirement to see if it's a source of a use, you don't look at the growth rate. You look at the actual dollars in the last dollar column, 2020 or 2019. If that is a negative number, then your working capital requirement is a source of cash. If that's a positive number, it is a use of cash. For Walmart, it's a source of cash because, and this is the hardest part, get this in your notes as best as you can. If it's a source, that's good. If the working capital requirement's a source, that's wonderful for liquidity. In that case, we want the growth rate to be as high as possible. So Walmart has a very strong growth rate, much stronger than almost anything else in their financials. They have really strong growth rates. So that means this source of cash is becoming an even better source of cash. So that's wonderful. On the other side, if this is a use of cash, so if your working capital assets are greater than your working capital liabilities, if it's a use of cash, you want that growth rate as low as possible and even negative. If it's a negative number, if their working capital requirement is actually dropping and everything else is positive, their earnings are growing, their revenues are growing, but their working capital requirement is a use of cash, but it has a negative growth, that means their liquidity is improving. That use of cash is becoming less of a use of cash over time. The other thing I do is give you net working capital requirement as a percentage of CFO. You can see for Walmart, it's 68%. That's the highest it's ever been, and it's a source, so that's wonderful. So Walmart is doing a great job of managing its working capital requirement. So now the question is, why is that? What are they doing specifically? So on the Excel spreadsheet, I don't have it in this worksheet, but on print page 1 at the bottom, I built this for you, for your company. You don't want this, you don't want anything below line 51 is what you copy and paste into the Word document. You want to stop that at line 51. But below line 51, you have the credit ratings and you have the working capital accounts. So here what you can look and try to figure out is, why is their working capital requirement getting so strong? And if you look at the actual graph, you can see it really started since 2014. That's when it got a lot stronger. You want this line going down. This is net working capital as a percentage of CFO. You want it to be negative, and you want it going down. If it's positive, you still want it to go down. So lower is better. So you want the working capital requirement to be as small as percentage of CFO as possible. For Walmart, it's actually negative 68%. But looking at this graph, we can see the trend really changed from 2014 and it just really nosedived. Since then, it hasn't dropped so much. So 2014 is a really key year. So if we go over here to print page 1, here's 2014. You can say then the working capital requirement is only $4 billion. That was actually the worst it's ever been. Since then, it's improved dramatically. So what I'm going to do is I've got my growth rates here. I'm going to add another growth rate. I'm going to do this from 2014. I'm just going to show you how I can do that. So to do a growth rate, you do the ending number dividing by your beginning number. Here we're going to use 2014. We're going to raise that to the what? Well, how many years is it? We got 1, 2, 3, 4, 5, 6, 7. So we're going to raise it to the 1 divided not by 7, but by 6 minus 1. That gives us our growth rate. So you already have the growth rate here, but that's for all 10 years. But because I can see a big difference. Now, your company might not have that. It might be smooth all the way down, so what you have is fine. But if you see a big kink in the graph somewhere, you might want to change your growth rate to do it from there. So here, what can we see? Well, receivables have actually come down. I don't know specifically what receivables Walmart has, but they've gone from 6.6 billion down to 6.2 billion. Their inventories have actually declined during that time. That's pretty impressive, right? If their inventories declined, even though their revenues are up dramatically, the revenues went from 476 to 524, you would think their inventories would have grown comparably, but they didn't. Their inventories, and that's the biggest number out here. So that is probably the most important thing of this whole thing, is the improvement in the inventories. Their other assets didn't grow much, and then their payables grew dramatically. How in the world did Walmart pull that off? The inventories are flat, their revenues are up, and their accounts payable are up. Now, I'm going to guess, I don't really know this for sure because I didn't do the research, and you may not know either. If you don't know, just say more research is needed. But I'm going to guess that Walmart is doing much more grocery today than they have in the past. And grocery, you tend not to have a lot of inventory on grocery. You don't want the bananas sitting there for 6 months. You don't want tomatoes sitting there for 6 months. So you tend to have much better inventory turnover with groceries than you do with shoes and TVs and that kind of thing. However, as grocery built, they're probably paying their grocery vendors just as fast or slow as they're paying their other vendors. So they may be buying bananas from farmers, getting them in, selling them really fast, and so the turnover is really fast. They're turning over bananas every single day, but they may not pay those banana farmers but once every 3 months. And so that's my guess. That's why they become so much more liquid. And so their liquidity has improved dramatically from $4 billion to $17 billion. Something else you have in this spreadsheet is the cash conversion cycle. You just have to go look for it. It may not work for your company, but it does work for some. And here we have these turnover ratios that we'll talk about some when we get to turnover. So I'm just putting this out there so you know about it. Their receivables turnover, their inventory turnover, and their payable turnover. And you can see with Walmart, their conversion cycle has gone from a negative 10 days to a negative 19 days. What that means is their operating cycle is producing cash faster than they're paying out cash, and that production of cash is improved by 8 days. That's a wonderful thing. And where's it coming from? Again, you can see in their inventory turn, it's improved from 45 days to 41 days, and their payables has improved from 57 to 64. The conversion cycle is these first two minus the third one, and that's why they're so good. If you look at Costco, they've also seen improvement, just not as dramatic as Walmart. All right, so you have that. We'll talk about this more. Don't worry about it if you don't understand this. We'll talk about this more when we get over to turnover. But again, I just want to emphasize liquidity and turnover have close ties to each other. If a firm improves its turnover, it's also going to improve its liquidity. So second thing we're going to talk about is looking at the net working capital requirement. We see that the working capital assets are less than the liabilities. That means working capital requirement is a source of cash. The normal for most companies is that it's a use. So we can say Walmart is incredibly liquid. Next thing we're going to do is look at the trend. So this is still under number 2. We look at whether it's a source or a use. Secondly, we're going to look at the trend in net working capital. So there's a couple of things under the second thing. And that's where we look at the graph of net working capital requirement as a percentage. Net working capital requirement is percentage of CFO. And we can see liquidity is improving strongly. I could have said improving strongly, especially since 2014. But here I put in some growth rates. I could have put in extra data from 2014 because that's when it happened. The last thing I do is say, why is that going on? And here I can say it's because the growth in inventories is less than the growth in payables. Here I could have strengthened this a lot by adding extra analysis related to 2014. All right. So here I try to explain what's going on. If you can't explain it, then you just say more research is needed to try to explain what's going on with my company. Now your company may be getting worse. So you'll have to change that. You can see where I pulled these growth rates from the table, so you can go down and look at that. You saw the 6.7%. The third thing we're going to look at is this concept of free cash flow and trying to ask, what is the firm doing with its liquidity? So I give you this chart 3. This chart 3, what it does is it looks at dividends, stock repurchases or issuance, and bond repayment or issuance. So this is a kind of a tricky chart. Let's look at the bonds. If the bond is green is below the line, that means they're borrowing money. If the green is above the line, that means they're paying down debt. So below the line, they're borrowing money. Above the line, they're paying down debt. The red, if it's above the line, they're buying back stock. If it's below the line, they're issuing stock. So below the line means they have a liquidity problem that they're having to go out and get cash from outside the firm. If it's above the line, that means they're producing a lot of liquidity and are using that to pay dividends, buy back stock, or repay debt. Now you notice that Walmart borrowed a lot of money in 2019. They did that to buy Flipkart, so I can actually explain that. So shareholder cash flows shows you the dividends they've been paying. You can see their dividends have grown 3.5%. Their stock repurchases, they did buy back a lot of stock in 2011. Since then, they've just been consistently buying back stock. So this negative growth rate could be bad, negative 8%, but I really think it's more of a case that they just bought a lot of stock back in 2011. On debt, you can see we have an NMF, and the reason for that is they borrowed a lot of money in 2011. They borrowed money in 2012, borrowed in 2013 and 14. But since then, they generally have been paying debt down, with the one exception, 2019, when they borrowed $12 billion in order to buy Flipkart. So you cannot have a CAGR if the sign changes from a negative to a positive or positive to a negative. But overall, their shareholder cash flows went from 11 billion to 14 billion. This is cash going out of the company. Look back in 2018, they sent $19 billion out of the company. The growth rate's not all that exciting, but again, the growth rate is a little distorted because they did a big thing in 2011. If you look at the growth rate since 2012, they went from 8.4 billion to 14 billion. That's a much stronger growth rate. So you can see with a CAGR, it's very sensitive to what your starting year is. If I'd done this since 2012, it would have looked a lot better. All right. Look at the capital expenditures. You can see capital expenditures have actually shrunk over that time, and they've been consistently shrinking. So capital expenditures for Walmart is them building new stores. They're still building a lot of new stores, but just not as much as they've done in the past. They were expanding overseas as well. So that growth rate is down. I'll look at CapEx as percentage of cash from operations. You can see it was as high as 56%, but this last year is only 42%. So they're not. So what is Walmart doing? They're sending a lot of money to their stockholders and bondholders. They are not reinvesting in the company. Their liquidity must be really strong, especially if they're sending $19 billion out of the door. Your CFO is not going, your chief financial officer is not going to send $19 billion or even $14 billion to stockholders and bondholders if they have a liquidity issue. So that's an issue where they show you they're definitely doing well on liquidity. All right, so I did not make it as far as I thought I would, which is almost always the case. So what we'll do next time is we'll start right here and I'll show you how you talk about these charts for Walmart. We'll move much faster as we go further, not because I'm going to go faster and talk faster, but because the analysis gets much easier. As I warned you, liquidity is the hardest part of this paper one, project one.